Not all tax deductions are created equal. Some save you a few $100s, some save you tens of thousands of dollars, and some have you paying literally zero on your income taxes. But nobody ranks them. Your CPA uses the bottom level ones, and the ones you need to know about are the top tier. Your CPA tells you about the standard deductions, maybe an HSA, and your financial advisor tells you to max out your 401k because that's how they get paid. Meanwhile, the strategies that actually keep you at zero are ones like Section 179, the Augusta rule, Reg D oil investments for literally every single person watching this, and nobody's telling you how to use these. So I'm gonna rank every single tax deduction strategy from the worst to the best, and I'm gonna show you how you can actually start applying them yourself, whether you're W-2, 1099, or you got screwed into thinking a 401k is a good idea and you wanna get access to money outside of it, keep the taxes at or as close to zero as possible, and multiply your wealth. Because the difference between paying 50, 60, 100 grand in income taxes and 5 grand isn't about the income. It's knowing how deductions actually work and how to stack them and use them. Starting in 5th place is the one everybody thinks should be in 1st place, which is maxing out your 401k. 401ks were the replacement for a pension. They're designed for your employer and for the companies the 401k takes your money and invests with. They're not designed for you. If you are told, hey, invest in the 401k, over contribute to it, get your little employer match, and then wait 30 years till you're 59 and a half, okay? Well, there's many things wrong with that. Is your 401k growing at 15, 18, 20% a year? No, that's the first thing wrong with it. If you're going at 8 to 12%, you can't outpace inflation, income taxes, or advisory fees, or fees with inside your retirement account. You're gonna have a net of zero. The second problem with this is the nominal value when you go to collect in retirement, great. Let's say you put in 6 grand a year for 30 years, you've invested 180,000, and it's growing at 7 to 10%. So after 30 years, you get $500,000. But let's say you want to actually touch that. Your advisor is going to tell you, well, stay below the radar, only withdraw 40, 50, 60K a year so you have low taxes, because they don't understand tax strategy. In other words, wait longer. That's the second thing wrong with it. The third thing wrong with it is if you do want to touch it all at once, well, guess what? You're going to pull out $500,000, and then whatever that tax rate is, you're going to pay earned income taxes on. So at that top tier, your cumulative bracket is about 35%. So you're going to give up $150,000, $180,000 to taxes, and you're going to be left with $350,000, except you waited 30 years to access it. So your nominal value is 350 grand. You invested 180, so you didn't even double your money over 3 decades. But because inflation stole 5% a year, your purchase power is less than what you invested in it. Bad idea. Now, this is where things start getting a little bit more strategic, and this is the 4th strategy. In other words, the second worst, and I actually like it. It gives you a little bit of a nominal benefit, and that's called the Augusta rule. Now, I'm gonna go quickly on this one because it's not applicable for everybody. You have to be a business owner and own a home to use the Augusta rule. What this means is your business can rent the home and get a deduction against your active income. So here's how it works. Let's say you have $1 million home and you go on VRBO or you go and look on Airbnb and you see that a home like yours in your area rents for about $1,000 a day. Great. An entity can rent that home for 14 days of the year for business purposes. So that's $1,000 times 14, that's a $14,000 deduction. If you have $200,000 in earned income, you're gonna have a $14,000 deduction, your AGI becomes $186,000. You might save $4,000 in taxes. A little win. Now this one is very, very rare, and there's only about 8 insurance professionals in the world that actually do this. I'm gonna explain how this works. Now this is called 100% tax deductible insurance. If you're a 1099 contractor or a business owner, you can actually have 100% tax deductible insurance premiums against your earned income. This is especially important for you if you are in a high tax bracket. In other words, you want to be in a high tax bracket to use this strategy, and you want to control the income. If you're W-2, you don't control the income. Taxes get taken out, you have what's left. If you're 1099, you control the income. If you're a business owner, you control the income. So you can actually contribute to an insurance policy. It's kind of like tax strategy number 1 that I'm going to go over, but here's how it works. You get a 100% tax deductible insurance premium. So let's say you make $200,000 a year and you're putting $40,000 a year into this. It's going to take your AGI down to $160,000. That's a massive write-off. Simultaneously, it's building a cash value component. So over about 5 years or so, you're accumulating cash value, which you can use to invest, or you can get a line of credit against, so it continues compounding inside your insurance policy, and you use that line of credit to go invest in assets like the number one strategy I'm going to go over, or even things like multifamily real estate where you're doing 2 to 3x on your net worth every few years. There's only literally 8 insurance professionals in the entire United States that actually do this. If you want to get connected with one, you can let me know in the comments. I'll explain this a little bit further, or you can just email me. So let's keep moving on. The second favorite strategy that I have is quite simple. It's Section 179, or in other words, bonus depreciation. Now, a lot of people get this wrong and they think that, hey, you have to have a vehicle that weighs over 6,000 pounds gross vehicle weight rating to use Section 179. No, that's not true. If you're 1099 or you're a business owner, you can bonus depreciate any vehicle that you use 51% or more for business, all right? If it weighs over 6,000 pounds gross vehicle weight rating, you conduct 100% of the purchase price in year one, regardless of if you financed it or paid cash. So I've got an F350, I use it for business. It was a $90,000 truck, $90,000 deduction. But I also have a Porsche that I use quite heavily and more than 51% of the time for business. Now that was a $250,000 Porsche, but I actually have a little bit over $20,000 of year one depreciation, and I can depreciate the whole purchase over 7 years. And I'm not going to pay recapture because guess what? I don't get rid of vehicles like that. And they appreciate, and I can get an equity line of credit against that vehicle while I continue driving it. Little extra bonus right there. And you can do that regardless of who you are. Yes, there are equity lines of credit against vehicles that you own. You continue driving them, you keep them insured, you get a line of credit against it, you'll use that to invest in assets that double to triple your net worth every few years, like the number one strategy that I saved the best for last. And that is Reg D oil investing, specifically Reg D, okay? There's Reg A, there's Reg CF. You don't get the tax benefits with Reg A or Reg CF. So Regulation D is comprised into 2 particular investment opportunities. 506B, which allows non-accredited investors to get in, and that means that you have a net worth of less than $1 million, or you make less than $200K a year, or $300K if you're married filing joint. Then there's what's called 506C Reg D, which allows accredited investors. You've got a net worth of over $1 million, or you make at least $200K a year last 2 years filing single, $300K if you're married filing joint. This allows you to get an 80 to a 100% write-off based on what you invest in year one. Here's how it works. Let's say you make $200,000 a year and you live in Texas where there's no income taxes, just to keep things simple. You're a W-2 employee, or you're pulling $200K from your 401K, or you have a capital gain you want to wipe out, or you have short-term, or you have long-term capital gains, or you have a dividend, or you have a work bonus, okay? Or you have a salary, or you're a 1099 contractor. Does not matter. You can wipe out any form of taxes on any form of income, passive or active, period, when you invest in Reg D oil. I'm not talking about stocks, I'm talking about oil funds. Now, this achieves a few things. You get an 80 to a 100% write-off year one. You get a 1.8 to a 2.2x return. That's what I am used to doing, and I've been involved in several funds. I manage my own funds. We do about 5 funds per year. So this is not coming from hype. This is coming from what I actually do on a professional level. You're gonna get a K1 loss. So let's say you make $200,000 a year. I don't care if it's $200K you've pulled from your 401K or $200K in earned income. Your tax rate on that $200K is about 35%. So you're gonna pay about $70,000 in taxes or so, and you're gonna keep about $130K, $120K on a $200,000 income. But let's say you decide to invest $100 grand that you have saved up into oil. That $100 grand at face value on the macro is going to double over 4 to 7 years, roughly. Okay, and it doesn't take $90 oil to do that. It takes 55, 60, very easy to do. Then that $100,000 investment is gonna give you a $100,000 write-off, 80 to 100. So against your 200K, you have a K1 loss of 100 grand. It's gonna lower your adjusted gross income to $100,000. So instead of paying $70,000 in taxes, you're gonna cut your taxes in half. You're gonna have a cumulative bracket of about $25,000, $30,000, a little bit less than that, about 25 grand on 100K. So instead of paying 70, 75K in taxes, you pay 25, okay? You've cut your tax in 1/3. Then that 100K is going to cash flow every single month. You're gonna get a wire into your bank account. 15% of that cash flow cannot be taxed because of something called the depletion allowance. How do capitalists stay in the 0% tax bracket? They invest in oil and natural gas wells, in new drilling in known basins, like the Anadarko, like the Cherokee Shale, like the Bakken, okay? These are all oil-bearing deposits. We have dozens of wells in the Cherokee Shale, for example. some in East Texas, and we're producing 600 to 1,000 barrels a day on many of the wells that we're invested in. So we'll have a fund, there'll be 30 wells in the fund, we'll do 1.8 to 2.2x. We'll sell the fund after 4 to 7 years. We repeat the process. We do about 4 or 5 of those every single year. Here's a fund, 22.6% average cash flow over a 3-year period. Here's another fund that's going to average 27%, 50%, and then 27% the first 3 years and do overall right about 2x, as I said. And that's based on $60, $70 a barrel oil, not 100, not Iranian oil prices, right? So Section 179 is your second best. Your 401k is the absolute worst, right? Augusta rule is going to help for a lot of you guys. 100% tax deductible insurance premiums for those of you that are 1099 and business owners. And if you are anybody and everybody on here, you want to do Reg D oil. So you hedge inflation, multiply net worth, increase cash flow, and you get those massive upfront tax deductions against any form of income while simultaneously getting a 15% tax free on all cash flow that you make from your oil and gas well investments. If you want to know more about this, you got a couple things that you need to do. Subscribe to the channel because I drop videos like this every single week, and it's no hype, it's no theory. It's based on results we're already producing. We have millions of dollars that we put in every single month in oil, have the track record, have the proof, and we work with partners that have been drilling and operating oil for over 4 decades. So if you want to know more about this, oil, natural gas, multifamily real estate, high IRR assets that your financial advisor couldn't possibly comprehend, subscribe to the channel, and there's a link in the description to register for my web class where I teach you how to tie all of these and other strategies together so you have a process you can follow to multiplying your net worth, increasing cash flow, and minimizing your taxes. Appreciate you guys, and I'll see you in the next video.